Welcome to Revere Asset Management's Your Money with Danny Stewart.
The market will always overshoot to the downside and to the upside.
And Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
Do you want Wall Street investing your money for you, on your behalf, in your best interest? No, I'm not talking about the broker's definition of best interest. You might be surprised. You ought to read that. It's actually in their best interest, not yours. You think that your best interest means your best interest. No, not at all. Anyway, do you want Wall Street to invest your money for their agenda, for their pie charts or us portfolio? Don always talks about the rotten vegetables at the store. You don't buy rotten fruits and vegetables for a balanced diet. Do you want rotten stocks and sectors for a diversified portfolio? Okay? Do you want declining assets in your account, or do you believe that it adds risk? See, at Revere, we think that holding crashing stocks and crashing sectors, or even sectors that are in a downtrend, add risk. We don't hold crashing anything at Revere or things in prolonged downtrends. Okay? Now, there's a few articles in the mailbag. One is talking about how medical expenses in retirement are going to be $172,000 when you're retired. But there are a couple of other articles that are kind of interesting. One is talking about the 21 states demand that ESG investing be, taken away. The big boys got to stop doing their agenda, their pie charts or us, their ESG investing or whatever they call it. And by the way, that environmental social investing, that was really the big lobbyists pushing their agenda so they could sell that kind of stuff. It really wasn't all that clean. Let the markets determine what is the best. But do you want Wall Street to decide social policy, or do you want them to use your best use for your money? The first and best use for your money. That's the question I have, because I'm going to pull back the curtain. But anyway, another article, Mariner and other firms agree to pay a $25 million class action settlement. So Mariner, American Century, and Tortoise Capital, all in Kansas City, all conspired, and they held prices down for advisors' salaries. So the advisors in Kansas City were not getting paid a fair wage because the big boys were holding them down. But the other article that's talking about this ESG investing, they're putting notice on Amundi, Blackrock, Bank of New York Mellon, Capital Group, Fidelity, Franklin Templeton, Geode, Goldman Sachs, Invesco, JP Morgan Chase, Morgan Stanley, Northern Trust, Nuveen, State Street, they're a big ETF, T. Rowe Price, Vanguard, and Wellington Management. So if you have any of those, they're giving you pie charts or us. Now, let me explain that so you understand that strategy versus our strategy where your money looks just like our money and your money will track exactly like the principles of the firm. We got all of our money skin in the game. We're not the guy on CNBC that says it's the greatest stocks and sliced bread. I don't own it. My wife doesn't own it. My company doesn't own it, but you should. You know why? Because the client is the company, not you. You're the cattle. You're the product. Anyway, so let's talk about this agenda about spreading your money around. What is Blackstone, BlackRock, Fidelity, Vanguard, New York Life, all these big companies? They're an asset aggregator. They are in the process of securitizing everything on the planet. They're buying companies, they're buying sectors and companies, and they're sticking them and stuffing them in their ETFs. How do they buy all these assets and these companies to stick in these ETFs? Why? With your money, you silly rabbit. Didn't you know that? They're taking your money and making it their money. That's what I've been trying to get the point across. And when I saw this article, I thought, I can explain it that way. So look, don't be that fool me twice moron, or worse, fool me thrice, or over and over. How many times do you have to be beaten? Why do you want a mediocre return where you get 7-8% maybe, if you're lucky 8, and you go down 30-35% every 5-6 years? Okay? Do you want a little bit of everything, a little mediocre return on the way up, and then that diversification lie, no protection on the way down, and you still experience bear markets? Or do you want the best stocks and sectors using measurable stats, statistics, data with a risk-managed sell discipline? That's a question. So again, at Revere, your money looks just like our money, and we are active with rules because price is truth, no exceptions. Every security on our portfolio has got to earn its way onto our portfolio. They're not predetermined. We don't have something in our mind. And then so they got to reveal themselves, and then they got to earn themselves onto our continue to earn their spot onto our portfolio. We don't do baskets and baskets of mediocre trash. Do you? Well, let me read that list again. Do you have your money at Amundi, Blackrock, Bank of New York Mellon, Capital Group, Fidelity Investments, Franklin Templeton, Geode, Goldman Sachs, JP Morgan, Northern Trust, State Street, T. Rowe Price, Vanguard, or Wellington? By the way, there's a whole bunch more. But if you're one of the big boys, you're an asset. If you're with one of the big boys, you're getting that asset allocation, pie charts or us model. That's what you're getting. I don't care if they call it a target date fund or lifestyles fund or asset allocation with some random date rebalancing at 365 day a year might be right. How do you know it shouldn't have been sold 2 months earlier before it dropped 20%? Now you're rebalancing 2 months late. Again, price is truth, no exceptions. All right. Now, before we go to the team, and you're going to hear how real professionals actually manage money instead of just farming it out to a bunch of mutual funds and give you a pie chart and then going and playing golf, we actually work here and we're doing the work actively, but we also go over a mailbag. And these are sent out. All these mailbags today just happen to be clients, mostly new clients. And there's a reason for that because I kind of want to go over the assimilation process. We've been getting a lot of emails. People are terrified. Oh my God, I'm so scared. The market's toppy. If we come on board now, how are you going to get us assimilated? How are you not going to get stung really bad? Folks, the market may just have a rip, snort, and rally from here. Who knows? It may go down. Now, today it's tough. But that's why you have to have rules. And that's also why we get in layers very judiciously until you're assimilated. In fact, until you're assimilated, you're the most important portfolio in the whole group in any event. I'm going to go to the mailbag right now. This is 725, and this is from TT. Thank you, TT. Love you. Dan's intro was unlike any I've ever heard. His interjected points anchored in Uncle Dan kind of vibe. The best you two have ever been. Though I've heard Don's heartbreak about his dad before, it never gets old. Best show ever. TT, thank you for the kind words. Music to Revere's ears. I'm going to have to go back and listen, though. I thought it was quite good, but so was the previous show. But we are hitting on all cylinders with the podcast messaging, and the portfolio management team is killing it on a risk-adjusted return basis and a total return basis, but I'm really more concerned about the risk-adjusted basis because you always got to know how much risk you took to get those returns. At Revere, we're way less risky than the S&P 500. Find out how we're doing against it. Anyway, TT, just to clarify, the Uncle Dan vibe is meant to be a really cool thing. I took it as such, kind of like Uncle Buck. And now I'm dating myself. Uncle Buck, the epitome of cool. Anyway, that was one. All right, on 729. Hi, Dan and Don. I hope you're both doing well. Best of my Revere team. I have about a year left before I retire and ask your opinion on these projections. I've been running on the Fidelity website. I have access through my employer. Specifically, no guarantees, of course. Their Monte Carlo stimulation, and ask if I can rely on those numbers somewhat. I used what Fidelity says is an average market return. Of course it is, 7%. And to be conservative, I reduced my initial starting amount. You are currently managing a few $1 million. My thinking, assuming Monte Carlo simulations are in the ballpark results. My thinking is assuming the Monte Carlo simulations are in the ballpark, my results could be even better than projected because of the way you manage the equity curve with drawdown rules in place. I don't know, but I would have managed the Monte Carlo simulation will take into account the full hit during a bear market where Revere has downside projections. It will. Monte Carlo does that. Because those pie charts or us do that. They go down 35%. Monte Carlo reflects that. We don't do that. The sequence of returns you talk about could possibly put me and my family in a better position down the road. True. I'm conservative by nature and always leave wiggle room, but I was hoping to get your comment, your thinking. Your comments are always appreciated. As always, thanks for watching out for us. Don, forwarded to Todd. Todd does our planning, a former CPA and CFP. Anyway, forwarded to Todd. We have a true benefit of downside protection, but how does that factor into simulations? ? So this is me. Due to the way we manage money, you should not experience the lower group of Monte Carlo simulation results. And I do not put too much weight into Monte Carlo, not the simulation itself, because of the users and the settings. Garbage in, garbage out, folks. We have Monte Carlo simulation in our portfolio management system, and it automatically downloads to Schwab Daily. Thus, even if we sandbag, which we do, and assume a 7 or 8% return at year end because you're downloading every day, our assumptions, your balance will have increased in real time by over 25% last year because that's how well we did, not 8%. So your real time balances will get adjusted, but your sandbag 8% return will still be in there. Okay. Therefore, our planning software updates in real time, but uses the assumptions. Due to sequence of returns and our management skills, our long-term returns range between 10 and 15% versus the S&P ranging between 7.5 to 16. I would rather give up 1% to the upside, which would be getting lucky selling at the absolute top on the S&P, but not how we manage. But not have the 7.5 to 10% lowest bottom ranges. In other words, I'm going to give up that 1% on the upside to make sure I don't have that 4% on the downside. That is the equity curve and sequence of returns in practical reality. I said you might possibly end up just slightly better with buy and hope, but you also might end up far worse too. That is the random sequence of returns when buying and holding with no breaks. There is no risk management, which in turns means huge drawdowns whenever random. Price equals truth, no exceptions. We can go over great detail on the phone call. All right. 729. Hope you're doing well. Happy to finally be part of the Revere team. Question. I saw several buys in my portfolio for existing grow holdings like PLTR and Hood, but were not adds to the grow portfolio in total. He's watching our newsletter. So how is the stop loss managed given my cost basis is much higher than the strategy, right? Also, I didn't see RBRK in my portfolio, even though it was an addition to grow per Connor's video. Can you advise me on any discrepancy? This guy's paying attention. I like this stock nerd. This is actually a Don question. But the stop loss levels are different for new money, especially when extended. But I don't want to misspeak on the actual level percentages. Don, I see RBRK in your account on my end. It wasn't there. The stops for all positions are added to your account are in line with or very slightly from the tightest stops used for all clients. We are also taking partial starter positions, meaning smaller position size. So your exposure is limited as we assimilate. If you're trading in the, he was doing some trades in the account. He had to do that. Understand, I will not trade my account. Okay. I also said, he was talking about stops. I also said, we don't use hard stops because the market makers know where the hard stops are and take advantage of retail investors all the time. Professionals do not use hard stops, but rather alerts. Once the alert is set, we put the appropriate order in and get it sold. This way you're not going to get screwed. All right. Now, the next one, and this is a very good team, 731. Good morning, Revere team. I was reviewing my account this morning and noticed I seem to be lagging the indices significantly on a strong up day. It looks like I'm still at 40% cash or treasuries. Is that consistent with the Grotection model? Is my portfolio fully ramped on board to Grotection other than the legacy? He had a legacy Google position and an illiquid opportunity fund. Ouch. Thanks for taking a good look. Don, hi, JD. Your account is fully assimilated with the exception of Google position replacing 5.5% of SPLG, that's the S&P fund, in the model. The oversized cash position is due to some recent sales. It came in to reduce volatility this week due to the numerous high-impact economic reports, FOMC, and high-profile earnings. As of 11:05 Eastern Time, this account is up 0.3 versus 0.45 for the S&P, and is due to Google, his position he transferred in, being down negative 2.2%. So the big drawdown in Google is really the culprit for that. Thanks for the prompt response and the explanation. Makes sense. So I want to make a couple of points. The dilemma. So here's the dilemma. You get in too fast. People either want to get in fast because of fear of not missing out, or they're worried about underperforming and they're worried we're going to get in too quick. So it's one or the other. Which fear do you have? At Revere, we get in judiciously regardless. Now, I want to talk about legacy positions because this is a huge point. This is a gold nugget for the show. Legacy positions, far often than not, yes, they cause you to save money on taxes, but they also cause you to have a lot more money at the end of the day with more risk. You're going to have less money with more risk almost always, every once in a while. So you will be poor on a cumulative basis. Now think about this. If you take that one big stock, sure, you have 20% capital gains that you're trying to avoid paying. That's the way you hold it long enough to get a big gain and it's outsized. You could actually sell that if it's not still leading. If it's a leading stock, trail up the stop. But if it's not a leading stock, you could sell it and you can diversify over 5 or 6 individual good stocks, spreading the risk versus one single stock. So one single stock does have more risk than a bunch of stocks. Now, when the whole market goes, you want to get rid of all of them because they're all going to go down. Now, will the stock outperform his stock? Most stocks with big gains, legacy positions, have already had their day in the sun. Now it could be outdated or simply a slower growth. It isn't the best of the best, or an IBD terminology, a true market leader anymore, a TML. So the question to ask always, price is truth, no exceptions, period. What is the price telling you about this stock right now, not in the past? Is it time to sell, or is it time to buy, or is it time to hold? All right? The right way to handle a legacy position is by price and unwinding judiciously when it's time to sell, when it stops acting right, or manage the position if it still is. If it's still acting right, you can trail it up for a while. That's the first thing. Second, these economic opportunity zones, these illiquid PE and new illiquid private debt funds are coming up with all these ETFs that are supposed to be liquid, but they're stuffing them with this private equity stuff. Remember, I told you they're securitizing the world. Blackrock and all these groups are trying to buy everything and stick them in these funds, okay? But these economic opportunity zones, these illiquid PE and private debt funds, these integral funds, okay? Why would you do that anymore? I don't do any private equity anymore. I don't have to. I'm making low double-digit returns with no bear markets ever. I don't need the headache of private equity and all this illiquid stuff. So what I'm saying is, why would you do that? You got to look at that. It's all about the risk-adjusted return. So folks, listen, this was a mailbag. These were mostly new clients. I wanted to discuss this, though, so you could see our transparency, how we go over this, how we bring up clients' topics, how we talk about stocks, how we pull back the curtain. What is your broker or your advisor telling? By the way, we're not a broker. We're a fiduciary. We only represent you. You'll never get a pie charts or us portfolio from us where we just sit there and set it and forget it. Okay? We actively manage money, and our money looks just like yours. And when I say just like yours, once you're assimilated, you'll get the exact same timestamp and position size in the portfolio. Your performance would track just like my mom's, just like Don's wife, just like our families, because we're buying the same stock at the same price. Everybody's done in a block trade. There is no cherry picking, no favoritism. Big, small, it doesn't matter. It's all the same. but it's not Pie Charts or Us, and it does a whole lot better. So with that, I'm going to go to the team. And when I go to the team, think about your advisor. And if you're your own advisor, think about you. Do you sound like these guys? Are you doing this kind of work? This is hard work. You can't just trade an hour a day, make $1,000, shut your computer and go play golf, regardless of what all those black box trading things tell you. If those things are really 92% accurate, why is that guy doing a little seminar at some money show? Why doesn't he own Maui if he's that accurate? This is hard work, and it's all about math and probabilities. So with that, we're going to go to the team and listen to them and see if your advisor sounds like that. Don?
Let's get them, Dan.
All right, giddy up.
So basically, what we're seeing today is after a 68 consecutive session where the S&P 500 rose above this green line here, that's the 21-day exponential moving average, and it's the short-term trend line that we use for allocating funds to the market at the index level. After 68 consecutive days, we're seeing a break of the 21-day moving average today. We just had a very strong July, but on the last day of July, we had a new high made on a gap up by Meta and Microsoft on their earnings reports. But if you looked under the surface, the equal weight S&P 500 was not confirming this, and in fact broke the 21-day moving average yesterday. And the market reversed. We saw it overnight where small caps were red despite this somewhat euphoric move by Microsoft and Meta. And we put in, this is why we track, and we mention this in the tail of the tape every day when we do videos. What is the opening range? Where was the high? Did you put in the high early? Then you need to get defensive or stay defensive or minimize aggressiveness at the very least for the rest of the day. Yesterday, we put in the high immediately. We closed near the lows, and it was the first close below the 8-day moving average in about 30 sessions. Follow that up today. Trump talking tough on some of the tariff countries that didn't come to an agreement before the deadline, which was today, and we've got a gap down. Set the news aside because there was bad news on the way up during this entire 68 session run. Go by what the price is telling you. That's what Dan says all the time. Price is truth, no exceptions, and that's the case right here now. So what we've got is, first, yesterday we had a break of the ultra short-term moving average that we use. That's the 8-day exponential. In a strong trending market higher, stocks will respect and ride that level, and we stick with them as long as they do. The break of an 8-day moving average means we look down to the next lowest time frame. That's the 21-day moving average. We gapped below that today, rallied up into it, and are pulling back some more as of 11:15 Eastern time on Friday. This is a change in character for our short-term trend. Our trend gauge, if we don't regain this by the end of the day today, will reflect that. And then that's the first time in 3 months that we've had a change on the short-term trend from being bullish. With that break, we look down to the next level to look at, and that's our intermediate term level. That's the red line, the 50-day moving average. And we're watching this on the indexes, and we're also watching it for every individual name that we have. Not shown on this chart are if the 50-day is broken is the 100-day and the 150-day. But if you look at a weekly chart, we track them. It's the 20-week moving average and the 30-week moving average. A mild to intermediate correction normally holds at the 20-week moving average, which is this green line here. You can see during this move up all throughout 2024, pullbacks were contained by this green line. We had one undershoot, another one there. But for the most part, the 100-day moving average / 20-week moving average is very important for the indexes. Stocks go on their own merit. If you break that 20-week, then you're in danger of getting down to the 200-day moving average. If you break the 200-day moving average, where nothing good happens under there, this is when we get to a maximum defensive posture. But those going from bear, which we did here, to bull takes quite a decent period of time for leaders to establish themselves, for the indices to decide that they're going to start going up and respect levels during pullbacks. It's just the direct opposite if you're going from bull to bear. The first thing that you do is you break the short-term EMA, then you watch the 21-day, then you see if the 8 EMA crosses below the 21-day, then you see if the 21-day crosses below the 50-day, you see if price breaks the 50-day, and you just do the exact opposite that we did going from bear to bull, going from bull to bear during a pullback. There's no guarantee that this pullback is going to be something terrible. It could very well right itself around the 50-day moving average or the 100-day moving average, or even a pullback to the 200-day moving average wouldn't be out of the question. We're entering a very weak seasonal time in the market, that being August and September. And our stops will take us out of the market for the individual names. We got taken out on 3 recent buys today. No problem. We size up our first buy so that our loss is only 0.15% in the Grotection portfolio, 0.15% of the total AUM or the total portfolio. So 3 of those got hit today. That's a 0.45 loss on the total portfolio. That's a paper cut. That's nothing. Our long-term statistics tell us that we take those all the time. It's built into the process. Our process has a positive expectancy, and over the last 6+ years, it has beaten the market with significantly less drawdown risk. In fact, I did a search on Perplexity trying to find an actively managed or even an index mutual fund that outperformed Revere over the past 6.5 years with a drawdown of less than 13%, and they were unable to find one. I don't think they went through the records of every single one, but this is how we separate.
I bet they did.
This is how they didn't. I'm 99% sure they didn't, because the data is not even available from some of the without paying.
Or the
without
reporting
paying up
entities,
to Morningstar and pulling up the exact data from that. But they look at a few of the big ones and they say no, they lost way more than that. Some of them didn't make as much as you did, but then again, that's why we focus on just the best of the best names and the best of the best markets. So right now, under the 21-day moving average, we've already trimmed some of our names. We trimmed into some strength when we were extended along the index with some of these. We've been talking in our nightly videos since July 3rd about how we got historically extended from the 50-day and 21-day moving average. We're below that level today. So really what we're looking at now, if you want to talk about trends, because trends are just higher, lower highs and lower lows, that's a downtrend, just the way an uptrend is a higher high and a higher low. And what we've done now is failed this breakout level. When you fail a breakout level, that's meaningful. The breakout level was 6280 to 6290. We talked about that weeks back on our videos. We were in an 11-day breakout that has now failed. You can't argue with that. You can't say, well, I think this, I think that, I think seasonality. A breakout failed, and there's a saying on Wall Street: when failed moves come fast, from failed moves come fast moves in the other direction. You can see the attempt Thursday morning to make a higher high. It failed immediately. We closed at the lows of the day, and we're following through to the downside, and that fail through to the downside broke that breakout level. So this breakout has now failed. We're back into the base, which is basically 6,200 to 6,300. That was the prior consolidation before we broke out. And now we watch that level. We'll watch the moving averages and horizontal support levels on the indexes. But you can see here, you break that level, the next level down is 60.50. That was the prior breakout to these most recent 2 breakouts. And you just reverse the process, going from bear to bull to going from bull to bear. And where it stops, nobody knows. We're not going to argue with it. We're just going to respect price and respect the action of the leading names. We're seeing quite a few of our leaders break below the 200-day or the 21-day exponential moving average today. Every Monday, we put out 21 leaders in our 2121 list that are liquid, and then we have the Turbo 12 list. for more aggressive names that Ted and Connor and TurboTection can traffic in. And this is, it's a pullback for right now. We're only a couple of percent off the top, but you have to be wary when a move that was going in a bullish direction failed, because it can reverse, and it can reverse quickly. Escalator up, elevator down. That's what's said about the market. And this is certainly a 2-floor drop on the elevator over the last 2 days. We don't know how we're going to close today. Yeah. We don't know how we're going to close today. We don't know how we're going to close Monday, or what we're going to do at all of next week. But we'll take our clues from the market and all the secondary indicators that we track, that we discuss in the videos every night.
But we're ready to sell quickly in case the cable on the elevator breaks.
And yeah, we don't want that.
Yeah.
And we don't want to get too bearish either. But
sure. Well, here's one little tidbit. You guys brought it up a couple days ago that, folks, there's only been 4 times in the last 50 years that you've had such a burst short-term rally for 60 days in a row. Don will give you the exact stat, but for 60 days in a row, staying above the short-term moving average. And it only happened 4 times. In other words, only 4 times it's been this prior has been as strong as a short-term move as this one. And in all 4 times, the market was higher 3 months from that time. This is about a week ago. All right. And in all 4 times, the market was up between 20 and 26% a year later, 12 months later. I'm not saying that's going to happen this time, because with us, price is truth, no exceptions. But just kind of keep that in your thinking about, so you don't want to get too bearish. This market could either go up 30% in the next 2 months or 30% down in the next 2 months. And if you don't understand that, if your mind's not supple enough to understand that, you don't understand the markets. You don't. Sorry, Don, go ahead.
Yeah, 30% is probably a stretch. That only happens during something like
COVID.
No,
it is. That is very, very uncommon, but it is possible. That's all I'm saying.
And the point is not to guess either way. Just obey price, follow the levels, all of the moving averages, the 3 that we key on, the 21, the 50, and the 200. They're in uptrends. They should, I say should, they don't always. They should provide support to a pullback. They did on the 21 for 68 days, and then today it failed. We've been above the 50-day moving average for not quite as long as that, because we're coming out of this tariff tantrum bear market. But we'll see what happens when we approach the uptrending moving average for the 50. And if that breaks, the level below that is the 100-day or the 20-week.
But by the way, Don, when you said you said earlier, we just went through a bear market earlier this year. When he says he's talking about the S&P. The S&P went down over 20% intraday. It only closed down just under 19%, but for the day. So technically it wasn't a bear market. But if you're an active trader and you're watching it, it was down over 20% for the day. We were down 8.5%. So we were down 1/3 as much as the market, and we were down 1/3 as much during the COVID bear and the inflation bear too. And anyway, go ahead, Don.
Yeah, we're pretty good at protecting capital when it's time to protect it, and completely transparent and open about it. We're not a black box. We discuss everything that we do on videos every night. As Dan and I like to say, the most transparent advisor in the country. Nobody does what we do. And the time to come to Revere is not when you've lost 20% at some other advisor. The time is when your account is near a high and you understand the risk that you could lose 20% and get with somebody who can protect it from happening.
By the way, Don, you were talking about the MAR ratio. Folks, I want to explain the MAR ratio. The MAR ratio is your return, your longer term return, your return divided by your biggest drawdowns, right? Now we had one years back that was about 15, but almost all of them are within 12, 10. We're getting better and better and getting shallower, but roughly it's our long-term average return is 13% annualized gross, right? And our drawdown is about 13. That's a 1. If you look at these pie charts of us, they're making 7, 8% annualized, and they're drawing down 30%, 25, 30, 35%. Their MAR ratio is like a 0.2 or 3 or 4. Okay. When you start getting toward 1 or you hit 1 on your MAR ratio, that's rock star material. That's like the best of the best in the world. So anyway, go ahead, Don. I'm tooting your horn for you because I know you're not going to brag
Well,
on you, so I am.
well, I appreciate that, and we we don't shy away from scrutiny because we put it all out there on video every night. So,
Yep.
um,
Bring it. Mhm.
so that's it from an index perspective. Let's turn it over to Todd. He's going to talk about a stock that is bucking the trend today after a very strong earnings report. And then after that, we're going to go to Ted, and he's got some very nice insight into uranium stocks and the role that different tickers play in the nuclear power industry for data centers. Todd, take it away.
Okay, today I'm going to talk about Reddit, which had earnings last night. And before we get into why it's up so much today, let's go back and look at the history of this chart. We see it was a new IPO last year. It had a very nice earnings gap in October that Revere was part of. Grotection bought a position in Reddit back in October of last year and did very well with this stock. In February, they had earnings and it was a great report, but it had dropped and reversed after being up substantially in the aftermarket on news that they took a temporary hit to traffic from a Google search algorithm change. So the stock went into a free fall and came all the way back to its IPO base here and really has just built a new stage 1 base during the last few months. Well, last night they reported earnings and they beat by 136%. And they came out with revenues of 500 million, looking for 425 million. Their ad revenues were up 89%. Their gross profit margins were 90.8%, which was up 130 basis points. And they issued upside guidance for next quarter for revenues of 545 million versus expectations of 473 million. So you've got the trifecta of beats here. You've got the current quarter beat by over 100%. You've got gross margins coming in higher than expected, and you've got a huge upside guide for next quarter. Okay. So since this debacle with Google, the CEO came out and said that they've rectified this algo situation, and their growth obviously came out stellar. And what's nice about this particular play too is it's one of the few stocks out there not extended. Yes, it's up 20% today, which is a nice gap up, but it's well off its all-time highs. And if you look at the earnings, Don, if you could go to the weekly really fast for me and just look, I don't know if the viewers are going to be able to see the earnings and sales because my face is in front of them, but they're triple digit sales and earnings growth. So this is really a classic can slim situation. And today on a down market, we've got a nice gap and the stock's trading basically at the highs of the day. So this is definitely a playable situation. The only thing really stopping it could be the market itself here if we go into a pullback or a slight correction here. But this is definitely a potential viable gap up situation on extremely strong earnings. Thanks.
Great summary, Todd. You pointed out a lot of good stuff there, especially the forward earnings. That's always something that we keep an eye on. Very often, when a chart like this comes up, you'll see for the current year, a stock may have triple digit earnings, and then you'll look at their earnings for the following year and they fall off of a cliff. That is a situation where the outlook is minimized to the upside if your earnings are going to fall off a cliff. So in this case, 152% this year, another 73% in 2026. That's amazing. Yes, the PE is on the high side, but that's always the case with growth names. And you can't say anything bad about the reaction to this. It's formed a very nice cup with handle. And this is certainly in the top 10 list at Revere for getting on board. Thanks for that, Todd.
Don,
Yeah.
real quick, so people can understand that growth, how that growth rate affects the PE. So that PE there says 146. Let's just round it to 150. Make it real simple. 150. Now the growth rate is 152. We'll make it real simple. We're going to make the growth rate 100. 100. Well, if your PE is 150 and you got a growth rate of 100, the very next year your PE just got cut in half because you grew 100% a year. So now your PE 75. Then the next year it's going to be half of 75 or 40, whatever. Then the next year it's going to be 20. So very quickly in a few years, that PE, if the growth rate is high enough, that's why it commands a high enough PE. It deserves it. So when you hear people say, oh, I'm a bottom fisher, or I'm a value investor, sometimes that's buying trash off the bottom. A PE is earned. The best of the best stocks are going to have high PEs because they have earned it. Do not be afraid of high PEs. That's where the best of the best stocks are. Sorry, Don.
All right. Let's take it over to Ted, who's got a great segment on uranium stocks.
Thank you, Don. So throughout this AI build out, we've talked about how there's huge electricity demand, which is energy, all around the world. And that is one of the great limiting factors of AI is this energy problem. And we've seen policymakers combined with the tech leaders try to address this whole energy issue. And so currently in the United States, natural gas produces the most amount of electricity, whether for commercial use or just household use. But we have to start diversifying into other forms of energy, especially for sustainability. And one of the most promising ones is nuclear. The thing with nuclear is there's a lot of regulatory hurdles, but also there's just a whole process and a whole stack of companies that have to mine the uranium, convert it into various forms, and then send it to the reactors. So in my segment, I'm not going to go over the regulatory side of things, but more so what the public markets offer in the stack of companies where you can gain exposure to various parts of the process of just the nuclear build out. So really to start off extremely simply, uranium is found in the earth and that needs to be mined up. So the first company I wanted to talk about is CCJ. If you can pull that up, Don. And CCJ holds the world's top uranium sites in America and Europe and Asia, and they're responsible for 16% of the global uranium production of the world. And URNM and URA are two ETFs that track uranium, but CCJ is definitely the major producer in this space. They also are a supplier of natural uranium, so just the uranium compound when it's mined out of the ground. And then they also enrich it to a form called low enriched uranium, which is up to 5% of just the natural compound. And then these natural forms of uranium plus their low enriched forms can be used for two types of nuclear reactors. One is called CANDU, and that's an acronym for Canada Deuterium Uranium. And these are just in simple way, they're designed by Canada and they can use natural forms of uranium as fuel, while most conventional current nuclear reactors and the new next gen advanced reactors and SMRs, small modular reactors, cannot use natural forms of uranium. So the current light water conventional, when you think of a traditional a nuclear power plant that uses low enriched uranium, which is pretty much they process it, refine the natural uranium to this more enriched form, and that can be used in these light water reactors. But as we expand and innovate on nuclear reactors into these what they're called Gen 4 reactors and SMRs, the smaller ones, even low enriched uranium can't be used for those. So there's another process that converts low enriched uranium to what is called high assay low enriched uranium, HALEU. for short, HALEU. And this brings me to the next company I want to talk about, LEU. It is the only publicly traded company that currently commercially produces HALEU. So it's really critical in the stack, in the nuclear stack right now. You can see it's made a huge move off Trump's executive order, which was in May, and this continues to be the only company. So it does a lot of the job, and it's critical to producing nuclear fuel for advanced reactors and small modular reactors. And so after this process, once LEU creates HALEU, the problem is it's in a gas form. And the gas form is uranium tetrafluoride gas. And for that to be then transported and used in the actual reactors, you need a deconverting process. And two companies that are publicly traded and are involved in this process is GEV. First one, they're actually mainly known for their natural gas turbines for data center electricity production. But they do have an arm of the company that works with the supply of HALEU and the deconverting process. And so during the deconverting process, pretty much they just turn this HALEU gas form into a solid uranium metal form, and that is more easily transported, less toxic, and it can actually be used in the reactors themselves. So finally,
That's a good looking chart.
yeah, it's definitely acting really well. And then another company involved in this process is BWXT, also involved in HALEU deconversion. This one recently broke out of a cup with high handle, has pulled back and reclaimed the 21 EMA, looking to reclaim the 8. So this is another one that's involved in the deconversion. So far, just to review, we've talked about mining uranium, which came from CCJ. They also enrich it to low enriched uranium. And then LEU goes further down the stack and creates HALEU. But before HALEU can be used in reactors and SMRs, companies like GEV and BWXT have to deconvert it into a solid form from a gas form, which then could be formed into rods or other forms of fuel for these nuclear reactors. And then finally, three very, very speculative companies right now who are still more or less in the R&D process. First one, SMR, and that ticker pretty much just tells you what it does. They research and develop small modular reactors. And the reason there's huge investment and promise in small modular reactors is that a data center can be built in the middle of nowhere, and you don't have to build a massive nuclear power plant that have to go through many regulatory hurdles, and especially in just more red tape states. Building just your data center in the middle of nowhere allows you to kind of create all the pipelines and infrastructure necessary uh, in an accelerated way and bypassing a lot of the regulatory hurdles that many states give. So an SMR can just be installed right next to your data center and just help power that data center with electricity. And they're much smaller and they can be more efficient too and cheaper to build. Another one, OKLO. This one's headed, well, I don't think it's headed by Sam Altman right now, but he has his fingertips in here. I think he invested in it and kind of helped start it. They also do research and development in small modular reactors and as well as HALEU. So they recently had news that they're partnering with some company to start developing HALEU. So if they do succeed in that, then they'll join LEU as a second publicly traded company to create HALEU as well, which is important again for advanced reactors and SMRs. And then finally, another speculative name, NNE. They're also completely just in research and development phase right now. And for all three of the previous ones, no revenues, no earnings. And they also are looking to do R&D in HALEU as well. So those are the three speculative companies. Before it was CCJ, LEU, GEV, BWXT. They are legit companies making money or at least producing revenues. And really from CCJ all the way to NNE, that's a quick highlight of the full stack of the nuclear expansion right now.
Good stuff, Ted. I want to bring in our newest employee, Jacob Raymond. has put together a great summary of the top 4 uranium and nuclear ETFs and what they hold. We keep an eye on these, and it's also got a summary of what the individual tickers do, the role that they play, and a performance graph in here. If you are interested in getting a copy of this, reach out to him. Just email jacob@revereasset.com. He did a really great job on this, and we'd be glad to share it with anybody that wants to have some insight into what's going on, because this theme is not going away. All of these data centers need an incredible amount of electricity generated to power them, and the most efficient way is these small modular nuclear reactors. And these are the companies that are playing a leading role in there. Of the ones that were listed, Grotection owns GEV, has owned it for a while. We've got very great performance out of that. Ted, I know you've owned LEU in Turbo. And it's a theme. We'll keep our eye on it, keep an eye on, as we do on all emerging themes. Growth stocks are the way in a healthy market to grow your account, as long as you don't ride the growth up when it reverses, tops, and goes down, and that's what stops are for.
Yeah, you don't ride it.
Dan, that is everything from the technician side. You can take it away.
All right. Well, thanks, Don. Listen, folks, does your advisor sound like that? Does your advisor get that technical and dive in there and then do a video every night after he's traded your account that day so you can know exactly what he did if you really want to? You have direct access to the money managers, or are you just another pie charts or us? I don't know. Maybe it's worth the investigation and maybe look at it and see. Anyway, if you just go to revereasset.com, up in the right-hand corner, there's a subscribe button. Just put your name and email address in. And this podcast, we do a daily market newsletter every night the market's open, short 5-10, like drinking out of a fire hose. Our stock nerds do that. And then this podcast, we record Friday morning, but it will go on our email blast on Saturday morning. However, if you go to YouTube, just go to YouTube and just search for Revere Asset and hit subscribe. Zach, our producer, will have this thing out by noon or 1 on Friday. Our stock nerds, that's how they get it, so they can do any changes before the market closes. And so we're the most transparent advisor out there, folks. And by the way, there's a contact us button next to that if you want a complimentary portfolio review, or you want a topic or a stock talked about on this show, reach out. And you can always, always, always call us old school at 855-REAL-WEALTH, because it's your money, not Wall Street's money, your money.
And it's not how much you make in the markets, it's about how much you can keep.